we're going to have, it's just a wrap up of what we've done. So we took around 22 sessions to complete part 1 for enrolled agents course. And the students here are sitting for the papers in the month of August. And this is supposed to be a wrap up session. So we are not going to take MCQs here because obviously there are a lot of MCQs that we've already discussed in the classes. The aim of this session is to kind of just bring everything that we've done in the last 22 sessions in your hand so that when you do your revision, you should be able to, this is a perspective that would help you understand how you should be revising at your end. Okay. So, what are we going to do? We are going to start with the form. So, in my opinion, and the way we have dealt with the subject, we have gone by the form. So, form was a hero. We've taken 1040, and then we have taken every section of the form. We have a partnership with Klein for the books, but so we have referred to the books, but only in the fag-in in order to help you guys with the annotation. But generally, when we do the teaching, it is devoid of any book. We just teach you the concepts, keeping form 1040 in the background. And a similar approach is done for the C corporate taxation as well as the others like S corps and the partnership. So today we're going to do the same thing. We're going to start with the overview of the form and then we're going to, so basically if you look at it, the entire part 1 has only 4 topics. We have form 1040 in detail, and then we have a brief section of schedule D, which is capital gains. The capital gains is a portion which has been dealt with a little separately for the simple reason that this is something which is applicable for both the form 1120 and if I say 1120S and 1065, which is C Corps, S Corps, and partnership, and for form 1040. So the concepts that we're going to learn in capital gains are going to be applicable in both form 1040, which is individual taxation, and the corporate taxation. Hence, we are dealing with property taxation as a discrete topic, which can be used in part 1 as well as in part 2. And then there's a brief section where we are just talking about the property kind of a tax. That means the wealth kind of tax. We're not talking about the income from those taxes because that's what's going to be dealt with in part 2. But in part 1, we are going to talk about 2 forms, forms 706 and 709. Both of them are one-time tax forms. Estate tax is a one-time tax form, and gift tax is again when you're supposed to be paying the gift taxes. Again, both of these, when it comes to, so for estate, there's another called trust, which we are not going to talk about in part 1, but estate and trust also has another, which is the income on these. And these are going to be tested in part 2 as a part of 1041. So basically, we'll give you the concept of gift and estate taxation and something called unified gift and estate taxation tax. But we are only talking about the wealth of the property tax at this point of time. That means we're not going to talk about the recurring income tax. That is something that you're going to be covering in part 2. Okay. So if you look at it, as I already told you, that we have 3 broader headings. So if I want to wrap up entire part 1 in my fingers, I'm going to talk about it like 3 things. First is your form 1040. The next is your capital gains. And again, we are going to, we could have done capital gains schedule D as a part of 1040, but we are going to treat it separately because it's going to be something which is common for both the forms. So we have taken out schedule D and we have discussed it separately. So this has form 1040 and all the other schedules. Okay, so we have schedule 1, schedule 2, schedule 3, the most important ones A, B, C, D, E, and then you have the self-employment form W2 and a basic idea of 1099s, how it's going to help you, and also a little bit about QBI, which is a separate form altogether. But QBI, AMT, these are topics which are not dealt with in details in EA. So we are going to just talk about the concepts that are discussed in the session. Then we have taken out a schedule, which is schedule D for capital gains. And the way we are going to do this, the common concepts which are going to be tested both in part 1 and in part 2, we are going to discuss it. There's a small part which is relevant for depreciation, especially for the C Corps, that we're going to do in much greater details when you go to C Corps. And then, of course, we have this unified gift and estate taxation, which only the forms 706 and 709 is going to be dealt with in part 1. Okay. So when we are going to do individual taxation, we're going to concentrate on Form 1040. There are certain topics like nationality, which is very important because this kinds of lets you know that if you are in the US, how are you going to be filed? What income are you going to offer for taxation? Then, of course, there's a form, complete form, starting from your status, your dependency, the income expenses. So, starting to the entire flow, we're going to learn. Then we're going to talk about the capital gains, which is how do you calculate the sales? How do you calculate the adjusted basis of the property? What are the gains that are outside the tax net? What are the loss that will not be allowed as a deduction? The two forms, 709 and 706. Okay, so in gist, yeah, I am assuming that 1 day before the exam, or let's say 3 days before the exam, I generally suggest that the students should not go and do any of the MCQs. All that they have to do is keep all the provisions in mind and kind of connect all the dots, and you should be able to know how Schedule D is flowing in Form 1040 and how the concepts of property taxation are related to the bigger picture in gross income. Where is QBI coming? So just revise the provisions. Okay, so I think whoever most of you guys are sitting for your papers in the second week of August, which leaves us 3 weeks. So the ideal form of revision that I would expect at this stage is that you would have finished all the questions at least once. You would have known all the provisions. So if any of it is pending, my sincere suggestion is that you should spend 3-4 days and finish everything that is pending. Once you do that, I'm assuming all your provisions are crystal clear in your mind. And then your strategy should be to take one part, revise it in a day, and sit with 125 marks question for 1/4 of the time. And wherever there is a problem, dig into that question a little bit more in details so that you're covering up. But now you should think of wrapping up, putting everything in hand, and then kind of having the holistic picture, not the topic wise picture. So if you're practicing MCQs, don't do it topic wise. You should be able to club all the topics and do it together. Okay. So as we say, the first part, which is the first part, which is dealing with Form 1040, the most important concepts are for nationality and the taxability. Again, most of these slides that I'm picking here are important slides, but these are the slides that have been dealt with in the real class. So what we generally ask is who is the person who's supposed to file tax return, which is Form 1040 in the US, and on what amount of income is he or she going to pay tax on? So the question for that, the first thing it's going to ask itself is, does this guy have a US citizenship? Because if this person has a US citizenship, then that person has to obtain a social security number that every person in the US has, then pay taxes. But and we say that that person is not an alien in the US. But in case if you do not have a US citizenship, then you're supposed to be following either of the two tests. One is the green card test or the substantial presence test. So if you recall in the class, we spoke about the fact that, imagine if you have somebody like movie Godfather. Don Corleone is trying to understand whether this person can be a part of the family. So we're going to give him a test period and say before the US citizenship, let us first figure out is this person worthy enough to be a part of our family. So before that, the precursor is a green card. So either if the person has a green card or that person satisfies a substantial presence test, which is again a number of days in the current year and in the last 3 years. So there are specific number of days for which you have to be physically present in the US. So this is the first one, you are a US citizen, and if you're a US citizen, you're going to be paying taxes in the US. If you're not a US citizen, which is a second case scenario, and so this is 2A and 2B. But if you have a green card or if you're substantially present in the US, you're going to be stamped as a resident alien and you're going to be paying taxes in the US. But if you're neither, so if neither US citizen nor a resident alien, then we need to ask ourselves, do you qualify for a dual status citizen, a dual status alien character, which is typically in case if somebody is married and arriving in the US for the first time. And if the spouse is filing a joint return, then you have an option of filing a joint return with your spouse. Okay. But apart from that, otherwise, everybody else becomes non resident aliens. And in that case, there are two things which is very, very important. In case if you are either one or two. That means either you are a US citizen or you follow the criteria for either the green card or the substantial presence test. That means either you're a citizen or you are a resident alien. You're supposed to be filing Form 1040 in the US and offering your income, which you've earned throughout the world, in the US for taxation, because you're basically considered to be somebody who's a part of the US family. But if you're a non resident alien, which is the third criteria, general rule, only if you're going to the US and earning money from the US, you have a business in the US, you go there and you work for a couple of months and you earn money in the US, you're supposed to be paying tax only for the US source income, the portion of income that you earn in the US. Okay, so typically these are the three criteria: who's going to be paying taxes, when, and on what amount. This is the first part, which is very important, because unless and until you know this, it's difficult to go on to the next step. Like, so we know who is supposed to be paying taxes and on what income in the US. So, what was a substantial presence test? So, when you talk about the substantial presence test, we generally say that in the current year, so if you're thinking about the year 2023, then you know that for that year, you've at least spent a month, which is 31 days in the US. And at the same time, if you take the last 3 years, that means the current year, the year before that, and the year before that. That means 2023, if I take an example, you take the current year, you move 1 year back, and then you another move 1 year back. But we have a weightage of the number of days, which goes down as time is getting older. So in the current year, you count 1 day as 1 day. In the last year, you count 3 days and 1 days. And in the year before that, you're going to count 6 days and 1 days. And if you add all of that up, at least 183 days you've got to be spending in the US if you want to qualify the substantial presence test. So, three hierarchies: citizenship, resident alien, non resident alien, citizen and resident alien taxed on worldwide income, but the non resident aliens only on the US income. So, this was the first concept that we did. Then, of course, we start with Form 1040. So, what is Form 1040? So, if I look at this Master Form 1040, now we're going to be led by this form, which clearly says that, see, we've filled up all of these basic details, and depending on your residential status and whether you're filing your return as a joint member of a couple or just as an individual person, you're supposed to be giving the social security numbers. So, now if you look at the form, we've got to fill up these boxes. And we're going to decode each of these separately. So we start with the filing status, then we go to dependents, and then the others we'll understand. So the first criteria here is the filing status, which is something which is very unique in the US. So if you look at it, the form has, there are 5 different filing statuses. So there are 5 different filing statuses under which the rates differ. So we have 5 status. Do we have 5 different rate charts? Yes, guys. I'm assuming that if you guys are preparing for your exam and writing your exam in the month of August, you should be knowing this. There are 5 different statuses. But when I look at the rate chart, do you find 5 different rate charts? Yes, no.
No, ma'am.
Please write in the chat panel with it. Write in the chat panel. So how many are there? How many are there? Can anybody tell me? How many different? Yeah, so you have 5 different status, but only 3 different rate charts. Why? Because a qualifying surviving spouse is typically following the HT married filing jointly rates. And married filing separately is half of married filing jointly. So typically you have only 3 rates. You have single, you have married filing jointly, and you have head of a house. Okay, so please remember we have 5 statuses, but only 3 different rate charts applicable, because the filing status as a qualifying surviving spouse is actually, the rates are equal to the married filing jointly couple, and married filing separately is half of married filing jointly couple. So what makes you choose a status, and what are the criteria? So please understand that tax is just like law. Provisions are given through what? Through the Internal Revenue Code, which changes every year. And for this year, you're going to, so for e-exam, you generally are tested on the provisions that have been issued a year prior. So right now in the year 2024 and early 2025, that means till February, we are going to be tested on 2023 IRC code. So what are the, so this is what we said, right? So if I look at 2023 rates, even though there are 5 statuses, there are only 3 rate structure. One is for the single, married filing jointly, and households. Qualifying widower is half. Qualifying widower is just equal. Sorry, qualifying widower is yeah. Qualifying widower is actually equal to married filing jointly, and the married filing separately is half of married filing jointly. Okay, so three different rate structure. And if you look at it very closely, you realize that the best rates are for married filing jointly, because the highest tax slab of 37% is attracted at a very high level compared to the others. And also, if you look at it, if you look at the gradations, it will end up having much lower tax incidence compared to the others. So this is the most economical. So this is the best. And this is the worst. And H of H is somewhere in between. Okay, so if you look at the bigger picture, we have a slab rate in the US, which is a graded rate. And if you look at it, the most economical status is married filing jointly. Single is the least important one, and married filing separately is actually half of married filing jointly. And HOH is somewhere in between. So, given a choice, it always works the best if I have a married filing jointly status. HOH works good if I'm able to qualify for the criteria. But if I'm in a really, if I don't have any option, then I have to pay the maximum taxes if I'm single. Okay. Now, MFS looks like a very good option, because I can just be married, be divorced, or even if I'm married and if I just want to pass and file a return, which is good, I can just go for MFS. But IRS doesn't want you to go through MFS. So you will realize that a lot of provisions would not give you the benefit if you are an FFS. Okay, so the MFS may look like a good enough option, but in reality, the IRS has pulled back a lot of benefits if you file as an MFS. So, nutshell, people are discouraged to file as an MFS. So in that case, how do you qualify? How do you do this? So if you look at married filing separately, couple, ideally it's a single day test. And even on the that day, if you're either legally married or staying together, doesn't matter if one of the spouses is dead or not, because even if one spouse dies, for that particular year, the surviving spouse can file as a married filing jointly couple. Okay, so what we say is this: either, so who's supposed to be filed as a married filing jointly couple? People who are legally married and staying together as of the last day of the year. So it's a single day test on 31st of December. If you're married, living together, even if one person dies, the surviving spouse could go ahead and file the day of death. The status is married filing jointly. The year thereafter, for the two subsequent years, if you follow the criteria and if you're ticking all the boxes, you can go and file as a qualifying surviving spouse. But please remember, death and birth are not prorated in the US. What do you mean by that? It simply means that even if the person is being born or the person is dying, we never say that, let's say half of the year the person, a new child is born and half of the year. We don't say for that person only half a year you're going to be having the provision as. So let's say a person gets married on 1st of July. We don't say that for half of the year you are single and for the other half you're married filing jointly. You never do that. Same with the death. For the year of death, for the year of birth, the status as at 31st December is going to be what is it on 31st of December. And death, if the person is not remarried, then the year of death, you can still continue to have the maximum tax advantage by filing as married filing jointly. So if you're not married, if you're married but you're legally separated, so if you're not married, if you're married but legally separated, then you're going to file as a single. There are two more. Okay, as I told you, there are a lot of provisions that are rolled back if somebody is not a married filing, somebody is filing as separate couples, right? So a lot of problems. So generally, people are discouraged to file as married filing separately couple. Qualifying surviving spouse generally is there to reduce the hardship of a person who's lost the spouse. In the year of death, you file as married filing jointly. But 2 years thereafter, if you have a qualifying child, So here the definition of a qualifying child becomes important. If you have a child whom you're supporting for the whole last year, in that case, you can file your status. So remember, it has to be for the whole year. So if the spouse has died, then 2 years after the year of death, provided the person does not remarry, you can choose the status as qualifying surviving spouse, provided for the full year you are maintaining a house for a child who's dependent on you. So here the dependency provisions becomes important. Okay. And please remember, this is the only provision where a child's definition will exclude a foster child. Okay. So we've done single, we have done married filings jointly, we've done married filing separately, and we've done qualifying surviving spouse. So what is left is now an HOH. Who's a head HOH? Generally, imagine somebody who's single. So that person is not a qualifying surviving spouse. That person is single. And that's so it's either you're single or you're legally separated or you're in the process of being legally separated and for more than half of the year. Remember, this is not for the full year, it is for more than half of the taxable year. You're maintaining a house where either if it's a dependent child, this person has to stay with you, or if it's a relative, person has to stay with you. The only exception is a parent who need not stay with you. So in your mind, envision that if you are providing for a mother or a father who's suffering from dementia and staying in a nursing care, then if you are the one who's maintaining their house or you're paying for their treatment and everything for more than half of the taxable year, then you're the person who can claim the status as an HOH and save taxes. Just because they're your parents and they're not staying with you because they're in the nursing home will not disqualify you from being an HOH. So the only thing that you need to remember in an HOH status is first that it's not applicable for people who are not related to you. So please remember the person has to be related to you. So for an unknown friend, for a boyfriend, for a girlfriend, somebody with whom you have a living relationship, anybody for cousins, people who are not on your direct live stream, right? So all of them, you do not get an HOH status. They may be dependents on you, but you will not qualify for an HOH status. So the first thing which is important is not for people not related to you. So no HOH status if somebody is not related to you. That's the first thing. And second thing is the parents need not stay with you. For all the others, the person has to stay with you for more than half of the taxable year. The only exception is the parent. Right? So what we've done first, we've talked about the nationality, the taxability, then we spoke about the residential status. We're done with it, right? When you go to filing requirements, who's supposed to file in the US? Anybody? Now, see, there was a huge change that happened in the US post the Tax Cut and Jobs Act. So suddenly we removed the dependency exemption and we said that we want to give you a big amount for standard deduction. So general rule, we say that if you are being taxed, that means you're earning something which is more than the amount that we're allowing you as a deduction, then you have to file returns in the US. Self-employment is a very big thing in the US because it's startup culture. So they say even if you're earning from self-employment, because that income goes outside the tax net, right? If you're working and you're earning, maybe there is no W-2, maybe there is no 1099s, you never know. So we say that if you, because see, the standard deduction amount is really high. So if you look at it from that figure to self-employment income of 400 is like a huge delta. So the only plausible explanation could be that if you're earning from self-employment, if you look at all the Silicon Valley companies, they just grew exponentially in a very brief span of time. So we say that if you're earning more than $400 or equal to $400 in self-employment, if you're earning money which is more than the basic standard deduction that we allow to you, and again, if you are a person who's dependent on somebody else's return, but if you have a passive income which is beyond a particular threshold, in that case, either of the three criteria being met, you have to file Form 1040 in the US. Okay, so three criteria, any of them you have, if any one you're following, you have to file the return in the US. Now, see here how MFS is discouraged. The moment you earn more than $5, if you're a married filing separately couple, you need to file your income tax return in the US. So they've given you a lot of disadvantage whereby the benefits of filing as MFS is practically nullified. And that is how they've kept it as an option in extremely rare circumstances, but discourage the discourage of the use of MFS as a status is obviously there, right? So what we've done the nationality, filing status, who needs to file. What is the due date? Generally, the due date is 15th of April. There is an automatic extension. What do you mean by automatic? Automatic means I file a form and I don't have to wait for the IRS to approve. The moment a form is filed, I get an automatic 6 months extension. But those 6 months are not for paying taxes. It's just for filing the returns. Okay. So general rule, okay, so general rule 15th of April is the due date for filing the returns, maybe extended to 15th of October if you file the paperwork for extension. But this extension is only for filing returns, not for paying the taxes. And in case if you are not a resident, that means if you're a non-resident alien and there are no taxes that are withheld on your form, in that case, the due date is 15 June. But this is kind of an exception. But you need to know that a lot of exceptions are tested in the e-exam. So you need to keep the provisions in your mind. Okay. So we have covered the filing status. We've covered who's supposed to be taxed in the US on what income. Then you go to dependents. If you look at it, why is dependents still there? Why is this definition still important? Because we don't have something called dependency exception. Why is it important? It's important first because the HOH status will depend on the dependency. And the second thing is there are certain credits like the child tax credit, and there are other credits which use the term dependence. That's the reason we still need to know what qualifies a person as a dependent in your return, even though we do not have a direct dependency exemption. What do you mean by that? At some point of time before the Tax Cut and Jobs Act, the number of dependents a person had, you just have to multiply it with a figure. And that many economic, incentive you had for taking people in and making them stay with you. But since Donald Trump's manifesto was to reduce the importance of immigration or to prevent immigration in the US, post the Tax Cut and Jobs Act, the full dependency exemption is gone. So generally, we say if the child races in your house, that means RACES. 5 criteria, all needs to be met. If they are met, that child becomes a qualifying child. The R, the A, the C, the E, the S, which means the person is staying with you for more than half of the taxable year. Person is less than 19 years or 24 if that person is a full-time student. That person is either, so see, child definition is a very wide definition in the US. It may be somebody who's your child, brother, sister, brother's child, sister's child. Everything is concerned here. But remember, it has to be directly your blood relation. It cannot be your uncle's child. That becomes a cousin. We don't really bother how much money is a child making. So the amount of money being earned by the child. Think about Will Smith's son. Think about all the child artists and the professionals. We don't care how much money they're making. The only thing is the child must not provide more than half of his or her support. Okay, so 5 criteria. If all of these are met, the child is supposed to be a qualifying child. If a person does not qualify as a qualifying child, there is still an option of qualifying as a qualifying relative, which is anybody who ports us, or the acronym is PORTUS, somebody who ports us to qualify you as a dependent. First, the person should not be filing a joint return with somebody else. The person has to be a citizen of US, Canada, or Mexico. Either the person has to be related to you, that means some kind of a relation has to be there. But let's say there's a friend who's coming and staying with you. In that case, the friend can qualify as a dependent, provided that friend is not filing his or her own return and also not filing a joint return with somebody else. And also that person is living with you for the whole year. Okay. So ideally, the person has to be related or has to stay with you for the entire year. This is where we are a little lenient and would allow people who are not related to you also to be claimed as your dependent. Now, this is very important that the person should not be earning a lot of quote unquote taxable income. So, if there's a mother who is working whom you are supporting, and the mother has a lot of passive income, but in all non-taxable or tax exempt sources like US municipal bonds. In that case, that whatever money that lady is making would not prohibit you from claiming that person as a dependent. What is important is the taxable income. The taxable income has to be less than $4,700 for the year 2023. And you must be providing more than half of the person's support. So, six criteria, all of them met. So basically, it's five criteria. If you look at it, it is PORUS. If it is not, so it's either PORUS or it is POTUS, either of the two. Okay. So if it is done, then that person becomes a qualifying relative. Okay. Okay. So this was the first thing. So if you look at it, what we've done, we've started with the form. This part we've understood. We've done the filing status. We've done the dependents. Now you go to income. Okay. So before we go to income, we're just going to relate all the topics. We start with gross income. So this is a big area in the US. Everything that you earn, even if it is money that you find under the carpet, or if it's money that you've looted, everything comes as gross income. You've won something as a lottery, you have cheated somebody, you've robbed a bank, you just found somebody, something is in the garden, and that's a big amount of money. Everything becomes gross income. So the first big area is to understand what do you do with special items of income. So there are a lot of income, things like interest, dividend, capital gains, passive income, active income, compensation from the employer, fringe benefits the employer gives. This is a pretty big area. So we understand what becomes a part of the gross income. Then from there, there are three valid reasons to avoid paying taxes. What are these three valid reasons? One is adjustments, other is standard deduction, and the third is itemized deduction. There is another one which is qualified business income deduction. Okay, so if you look at it, there are four areas where you can remove your tax in. So basically, whatever income you're offering for taxation, I give you four reasons to not pay tax on certain amounts. One is above the line, and it's termed as adjustment. Okay, so what is an adjustment? I have given you a list, and I have a very sincere suggestion that you guys should have on your fingertips what are the items that qualify as an adjustment. Because when I give you so many provisions, it's important to keep everything in your hand. So the acronym that we use in our sessions is WISE as him. So one is all the attorney fees that you pay in whistleblower cases. The other is IRA. This is a big ticket item. Okay. The at the rate symbol is generally used for all the cases where phase out is applicable. Okay. So if you have a phase out, then you need to know, okay, this is the area where phase out limits are applicable. IRA is a big ticket item here, and we are going to discuss IRA in a little bit more detail in today's session. So generally, we say that if I'm paying for a discrimination case that I win, then the attorney fees that I pay will be offered for adjustment. If I'm contributing for my individual retirement account, depending on what kind of retirement plan I'm associated with, there is a part that I can get as a deduction, which in the year 2023, the maximum deduction can be 6,500 for a person filing as single or HOH, and it can be 13,000 for a person who's filing as a married filing jointly coupled. Then we have student loan interest expense. If I have a student loan in my name, that's important. Then if I'm paying interest to a particular threshold, that interest can be tax free. We have educator expenses. So if we are kindergarten through class 12 teachers, and if we are spending on the teaching on something related to teaching, then those expenses, if not reimbursed by our employers, we would be getting a deduction for that. And for a married filing jointly couple, the amount is double. Now, divorce settlements or alimony payments, generally in the Tax Cut and Jobs Act, there was a huge difference. We won't talk about this. And when we're discussing this, we will see how it is related to the adjustment as well as the gross income. Again, as a self-employed, there are certain deductions which I'll be getting in contributions to health savings account, the interest withdrawal penalty, the moving expenses. So there are 4, 5, 6, 7, there are 9 reasons And we are not going to be dependent on anyone. Even if you have one element out of these nine, it can be taken as an adjustment. But you need to know how many of these are the adjustments. I don't care if I have IRA and A. I can take I and A. We don't have to sum up everything and then all of it will have to go together. Any one of these, if it is there, till the limits mentioned, can be taken as a deduction. Now, why do we call it above the line and below the line deduction? Because this is a very important parameter in the US. And AGI typically means that we have segregated the US economy into certain criteria, depending on certain criteria. So, depending on how much AGI you have, I'm going to put you into classification. You're poor, you're rich, you're super rich. Now, these are not terms that IRC defines, these are terms that we define. Why? Because as you increase in the ladder of your income, you're going to roll back and pull back certain benefits to you, because we have something called progressive taxation. Throughout the world, general rule, we feel that the person who's earning a lot has to pay a lot more towards taxes. So all the benefits that I give you, we are not going to be giving it to you if you're earning a lot of money. So what money are we going to define as lot of money? It is AGI. Sometimes I use the word MAGI where they make certain modifications in the AGI. And that is the reason AGI is regarded as a big threshold. So we say above the line and below the line deductions. So the line that segregates AGI is the most important line in the US, because on the basis of that, we determine how much benefit we can give to different parties. So we have above the line, below the line adjustments. Below the line, we have actually, so if you look at it, we have standard deduction, but this standard deduction is like a plain vanilla deduction. And can you see it's a big amount? For a married filing jointly, we have 27,700 for an HOH. And then we have extra standard deductions that's given to people who are either blind or if they're very old. And if you're both blind and old, then you get double the benefit. Okay, so it's either the standard deduction or I give you one big hobby list of another deductions. But now these deductions, we cannot see it like the adjustments, because these deductions, we have to put it all together in a bundle and we have to compare with standard deduction. If this summation, so typically the way I remember it, as I use the word summation, it's either the itemized deduction or the standard deduction, whichever is higher. Again, that means this does not have an individual existence. This does, right? This does. So we're going to put, there are 1, 2, 3, 4, 5, 6. So particularly 6 reasons for you. We're going to club all of those reasons, map it up against the standard deduction. Whichever is higher, we're going to take that and we're going to bunk the other one. Okay, and then we have a deduction which was applicable once. What happened was we reduced the corporate tax rate from 31 35 to from 35 37% to 21%. Why? Because a lot of US business was going outside the US territory, so we wanted to make business in the US attractive, so we reduced the corporate tax rate. But then there are a lot of flow through entities in the US who did not benefit from the reduction in their rates. Why? Because that was applicable only for C Corps. So if you are a flow through business entity, which means if you're a sole proprietor, if you're a partner, or if you are the LLP member, so any kind of partnership, the sole proprietorship and S corporations, which have a flow through business entity relationship, we want to give them 20% of the business earned income as QPI deduction. So if you look at it, there are certain parameters which depends on how much money you're making and what is the kind of business that you're running. Depending on that, we have the QPI deduction. So what do? We start with the gross income, we reduce above the line deductions or the AGI or the reductions to arrive at the AGI. Then we have the standard or the itemized deduction, whichever is higher, and the qualified business income deduction, which gives you the taxable income. Once you get the taxable income, you apply the slab rates depending on your filing status. Now we know there are 3 different slab rates for 5 different statuses. And we are going to add all the other taxes like your self-employment tax, or we have something called net investment income tax. And then we are going to get 4 reasons to avoid the taxes. So this is very important, right? Because once you calculate anything which becomes a part of either your itemized deduction or your adjustments or your QBI deduction, the saving that you have is at the rate of your maximum income tax rate, which is 37%. But if you have something as a credit, the saving that you make is $1 to $1 because the number of credits you have, you can decrease your taxes by the exact same amount. So a credit is always preferred to any kind of a deduction to arrive at your taxable income. So you need to be very mindful of the terms taxable income, adjusted gross income, and then the reasons of why a deduction is not as beneficial as a credit. We'll give you a lot of lists of why credits are important, what are the various credits, and after that, the last deduction is on account of all the payments that has been made on your behalf by somebody else to the IRS. So if you have paid some advance taxes, if your taxes have been withheld, and there are one or two credits which are termed as refundable credits. You are in a pathetic state, and the state is helping you survive in the US. So you get something called an earned income credit. So if your earned income credit is there, you can still claim refund. So typically the deductions that you get for taxes are bundled into two. One are non-refundable, which we technically term as credits, and then the other is refundable, which we technically term as payments. Okay, and in the end we get taxed to your tax refund. So what we have decided, what we have written here, each one of them would be blown up and would be dealt with in greater details in each of the different columns. So the entire first half of the discussion is what makes your gross income, then what is your adjustment. So we have to know all of these 9 reasons for adjustments with all the details. Then we have AGI. From the AGI, so in your mind, guys, all the first 10, 12, I think 9, 10 modules that you have in whichever book you're referring to, in your mind you should be able to have the entire. So I have dealt with each one of them. So it's like saying I have a 30,000 feet view, then I have gone deeper into each section, but when I revise, this becomes my master schedule. This if I can do very well. So I have all of these smaller parts, which if you do it in greater details, then everything with the numbers, with the figures, you should have in your mind. So in your mind, you should sit and you should start revising. Okay, gross income, these are the important things, and adjustments, these are the 9 ones, these are the provisions. So when you revise, this should be all in your mind. In standard deduction, these are the limits. Who will get the extra standard deduction? Itemized deduction, casualty, charity, medical, interest, taxes, other itemized deduction. Each one of them, you should know the provisions individually and then you revise it all together. Then you go to your QBI. Again, there are certain limits, the reasons. So ideally, if you've spent 20, 25 hours doing each one of these areas, after that, revision is very simple. So this slide becomes your master slide, where we are just droning up everything and doing everything at a level where you can connect all the dots together. Okay, now ideally in our 22 sessions, we gave in some, I think 17, 18 sessions on doing each one of these in much greater details along with MCQs and everything. We are just reproducing a bit of it here for your benefit. But this is exactly how you should revise. This should be a master schedule. Take each one of them, dealt with in much greater details, and you should be revising this every day. Okay, so make one schedule for this, one for gift tax and estate tax, third for the property taxation. 3 slides, and wherever you're getting stuck, go to that portion and zoom in and do it properly, and again come back up. Okay, so if you look at it, what was there in gross income? We have different categories of income. One is anything which is not belonging to the other categories. The other was portfolio income, which is typically interest and dividend. Then we had a lot of passive income, which was Schedule E, where the most important ones were rentals and the money that you get as a share of a partner in an LLC, partnership, or an S corp. Then, of course, you have capital gains, which we're going to do separately. And everything else becomes part of your ordinary income. Now, why is this classification important? Because this is an unearned income. Okay. And later on, when you do something called net investment income tax, you will see how the unearned income, along with capital gains, we have a threshold beyond which we want you to pay net investment income tax. This is important because when you do passive activity losses, you will see that these losses can be offset only against passive activity income. That's the reason why these classifications become important. Okay. So when you look at gross income, now see, gross income itself is a big area in the US. We're going to talk about some of the most important terms there. Now, these are our actual slides. And I know this might be a little intimidating right now, especially for people who would not have done the classes with me. But see, the reason why we're having this session is to help you understand how you should be revising, 2 days before your exam. What is it that should be in your mind and how you should get there? So it's important to keep a drone view of everything that you have. So if I look at gross income in my mind, I will put it in certain silos. The first silo is everything that I work for somebody and earn, which includes salaries, which include all my sick, vacation pay, holiday pay, which includes my bonus, commission, prizes, awards. So you see, prizes and awards is a big thing. They tell you, is it a part of accountable plan, non-accountable plan? And you have to understand that cash prizes. So each of these have a greater details, and if you dig up, you'll find it something bigger. But this is typically what you have to keep in mind. So if it's a cash prize, I know that it will not be regarded as an exemption. But if there's other prizes that I'm getting out of safety or length of service, then I know that there's a certain level beyond which only I'll have to report. So all of this, and also remember when you're doing it here, you are talking from the perspective of a person who's receiving this money. But then when we go to part 2, you will know all of these, but from the perspective of a person who is paying you this, right? So all of these provisions that you do today is going to be relevant even in part 2. If even if you're getting a tip income, if you're a waiter or if you're somebody who's earning money as tip income, you will see that how the tip income, and this is actually, these are small topics, but which are preferred a lot as far as your MCQs are concerned, right? Then we have all of these expense which are not reimbursed expenses. So accountable, non-accountable, canteen plan, all of that we did will come here. Health savings account. On your behalf, somebody else is contributing. That will become a part of your salary. Non-cash payments. So all the taxable fringe benefits, again, is a big area that we spoke about. All of that, if you're getting, you have to take the fair market value of that and include it as a part of your wages. If your employer is paying you for a group term life insurance and the premiums are for more than 50,000 worth of coverage, then the extra amount of premium that is paid will become taxable in the hands of the person in respect for whom the employer is paying that figure. Again, educational assistance. Here you will see that till 5250 of the payments, if the employer is making, or even if it's a student loan which is being paid by the employer, you get the exemption. Only beyond that will be included as a part of your taxable income. If there's any adoption benefits, so your adoption expenses reimbursed by your employer to the tune of, now these are indexed figures, guys, which keeps changing every year. For the year 2023, these are the limits that you should keep in your mind. Again, if you are working, but in order to help you work, there is a person who's taking care of a dependent who you have to support. So maybe a child who has a person who's looking after that person, or you have to put that person in the daycare. All of that till $5,000 reimbursed by the employer is exempt. Okay, Medicare, taxes. Okay, this was important. If you're a person who's working as a household employee, then the wages that you're getting, if the amount is more than 2,600, the person who's paying you the money has to deduct the TDS and then pay you the money. Okay, bargain purchases and that. So all of these have been dealt with in much greater details. But when you revise, one big silo for gross income should be the money that you receive by working for somebody, and that should be there in your mind. Okay. Then we have all of these silos, right? Now you know this again. This all of these. Remember the provisions that you do for a recipient's perspective. The same thing you have to think from the perspective of the payer, which is going to be dealt with in much greater details when you're doing either Schedule C or when you're doing Part 2, which is C Corp's expenditure review. Okay, so one big area was in case if there are all of these life insurance contracts and what you do. So one big area was that in case if the contract is in the name of a company and if the company is paying the premiums, when you pay the premium, you don't get a deduction. When you get a payout, and the payout till your premium is tax free, but anything apart from that is taxable in the hands of the company. But if there is a premium that is being paid for a life insurance where the employee's family is a beneficiary, then the payout will become completely tax free in the hands of the beneficiary. Okay. And in case if the beneficiary is not agreeing to get one time payment but defer it, then the interest on deferred payout is always taxable. Okay, so there are some bigger perspectives that you need to keep as concepts in your mind so that you don't get confused. Okay, then we had these divorce. So one was the payment that you receive as a worker, right? The other section was alimony, divorce settlement. So we know that after the Tax Cut and Jobs Act, there was a big difference. So what used to happen? So what is important is understand what is happening now. So what is happening now is this. Okay. So what is happening now? What is happening now is simple. The amount of money that is being paid as alimony or divorce settlement is not regarded as income for the person who is receiving. Okay. It is not regarded as an income for the person who is receiving, and it is not regarded as a deduction for the person who is paying that money. So imagine if Brad Pitt and Angelina Jolie have separated. I don't know what is their contract, but let's say there was an alimony which was being paid. If the divorce agreements are signed after 31st December 2018, then the money that Brad Pitt pays to Angelina Jolie, in case if that is, then Angelina will not regard it as her income and Brad will not regard it as a deduction. That is what is happening now. Okay, so any part which is being given as child support, any part which is being given as alimony, any part which is being given as property settlement, nothing will be taxable in the hands of the recipient. Everything will continue to be taxed in the hands of the payer. But what used to happen for agreements before the Tax Cut and Jobs Act? So remember, the key thing is not when are you making the payment. The key thing is when was the divorce agreement signed? If the agreement was signed before the Tax Cut and Jobs Act, for child support and for property settlement, we had the same concept. But for alimony payments, we used to regard it as an income of the recipient. And we used to tax it in the hands of the recipient, and for the payer we used to give them as a deduction. So this was the only difference, and that too only for alimony. And after the Tax Cut and Jobs Act, we removed that and we have now made the provisions sacrosanct. So when you go and do capital gains, you will see that divorce property settlements are not attracting capital gains. It is not regarded as a deemed sale from the from the giver's spouse to the recipient's spouse. So we are going to not tax capital gains in it. Similarly, any payments for child support is not regarded as something which is being given by one party to another, and it is not regarded as a taxable event. So post 31st December 2018, any kind of a settlement for divorce is not regarded as a taxable event. Okay, so this thing is important in gross income, in deduction, and in capital gains. So once you do it properly, you don't have to repeat it again. Okay. Okay, then you go to all kinds of compensation. Again, these are stuff which are smaller stuff, but sometimes you get a lot of questions from these areas. So, any kind of a compensation that you get for injury or sickness, you need to understand that typically, if the payment is being made for disability, workers' compensation, accident, health insurance, medical care reimbursements, damages for physical injury or physical sickness, and a case in which there is physical sickness and emotional sickness, and then you're getting the payments. All of these are outside the tax thing. But this is important. If somebody is getting you payment only for your emotional distress, if you're earning an interest on that award, so I was supposed to get $1 million, I deferred that payment. Instead of 1 million, I wanted to get it as 20, 20, 20, 20 in 5 installments. Instead of 1 million, now I'm getting 1.5 million. In that case, the extra is interest, and that will be taxable. Okay, any compensation that I get for a slander. So I've put a case against you and I won that case against my business reputation or all of that, that will become taxable. Out of court settlements for lost profits. And so these are finer points, but you have to keep in mind. And this is a common code that is going to be applicable the time of your company when you're making this payment as a deduction, when you're receiving this payment as a person who's getting it as a part of gross income. Take both the sides and understand it properly. Okay. uh 1 second. And then we have all of these employer provided benefits. Okay, now this is like taking it an extra step and trying to put everything. So when you're doing gross income, one is when you're earning from your employer. So the earnings from the employer could be, you remember we spoke about dependent care. So this is just a drill down of what we did in that slide. Payment that you're making for life insurance, death benefits, pensions, all of these, we will do it in a much greater details, and then ultimately it will all wrap up and become one slide for you for cross income. Okay. Uh, yeah, this was important, right? This is another key concept in gross income. We say that if there is a return of a benefit that you received in the earlier years, then are you going to tax it or are you not going to tax it? So we say that, see, if we have taken a benefit out of that amount in the earlier years, only in that case, now if that benefit is no longer applicable, we're going to offer it to taxation. Say, for instance, I had used itemized deductions and I had paid state taxes last year. But I was not convinced of the tax, and I had put up a case whereby I disputed it, right? So I paid the taxes and then I disputed the case, and then I won that case, and the state government gave me the refund. So the refund that I'm getting is a cash inflow today. Would I be paying money on the cash inflow? So I will say that, see, did I get a tax benefit last year? How do I get a tax benefit? If I would have claimed the itemized deduction and if that claim would have lowered my taxes. So if I would get a tax benefit earlier, we would be taxing that refund, else no. So if let's say last year we used standard deduction, or let's say last year we used itemized deduction, but irrespective of the amount, the threshold limits would not have been reached. So irrespective of the amount, I don't get a tax benefit. So every time where a earlier tax benefit is nullified, we need to offer it to taxation only if there was a benefit received earlier. Else, no taxation. Okay. So we did a lot of sums in this, if you recall. Each of these that we're doing, we've drilled down further. But now when you're remembering all of this, you're going to do it in like a macro perspective. Again, when you did interest, you remember in interest, we had so many things. Typically, the most important part is what interest is taxable, what interest is not taxable. Not taxable is very important. If I'm getting interest from state and local government, if I'm getting interest, which is in a form of a gift that I'm getting, if I'm getting interest on education bonds in the US, if I'm getting interest on a private activity bond in the US, all of these interests are outside the tax net. But general rule, if the interest is being received on federal bonds, if the interest is being received on corporate bonds, if the interest is being given for deferred payout, right? So I was supposed to get a life insurance proceed of $1 million. I I accepted your offer of not paying the down payment, but then paying it over a period of time. So even though the life insurance proceeds will be tax free, but the deferred interest would be taxable. Okay, any kind of interest on late payments are taxable. So there are a whole dhobi list of things that are taxable and non-taxable. Okay. And then we went to dividends. Now, dividend has a common chord which said that in the US, any kind of a C corporation earning is taxed twice, one in the hands of the company and then the other in the hands of the recipient who's earning that dividend. So, general rule, the dividends should be taxable in the hands of the recipient, provided they are coming out of current or past accumulated earnings and profits. But if the company has exhausted all its current profits and still the company is giving you dividend, it is regarded as a return of capital. So I invested $100. Sorry, guys. Mm, 1 second. Oh, yeah, where were we? Yeah, we were here, right? So I invested $100 in your company. And out of that $100, the company made it, let's say, $250 because of earnings over a period of, let's say, 3 years. So that extra 150 is their earnings and profits. So till 150, if the company pays me dividend, it will be taxable in my hand as dividend. But if the company goes ahead and pays me dividend beyond the $150, then let's say the company pays me dividend of $200, let's say. In that case, out of this, 150 will be taxable because that is from earnings and profits. The balance 50 will be regarded as return of capital. And your investment in shares would come down to $50. And let's say the company is exhausted entire money that you invested. And then again, the company is giving you money. In that case, it is regarded as capital gains that the company is making, which the company is distributing to you. Okay. So three things. Dividends out of earnings and profits is taxable as dividends in the hands of the shareholder, where Schedule B. If it is return of capital, it is non-taxable. But if all the money that you have invested in the company has been returned to you and you will still continue to receive dividends from the company, it is regarded as if the company is distributing its capital gains to you, and that becomes taxable in your case. Okay. And of course, in the US, why is it that the dividends are taxed at reduced rates to you? Because the companies have already been taxed once. So we say that, see, if you have already been taxed once at the company level, then when the recipient is earning that dividend, provided that dividend is coming from a US company, and the person who is receiving the dividend has held to that dividend for at least 90 days period before and after, I'm going to say that yes, the person who invested in the shares has held it not for just the speculative purpose, but for holding it for a substantial period of time. And then it'll allow you to pay lower tax on those dividends. Okay, so we have dividends, which we term as qualified dividends. That means dividends coming from a US company and the shares being held by the shareholders for a substantial period of time before and after the dividends. We call them qualified dividends. And if you look at it, the individual maximum tax rate is 37%, but the qualified dividend rates, which is exactly the same as long-term capital gains tax rate, is maximum 20%. That means in the US, if you're showing something as a capital gains, long-term capital gains, you're in an advantageous condition because you end up paying lower taxes on that. And if your AGI is really low, depending on your filing status, you may end up not paying any tax on those dividends or on those LTCG. So qualifying dividends and LTCG rates are same. Okay. Okay. And then, so if you look at gross income and if you characterize it in different silos, you will know that first is when you receive it as an employee. Second category is portfolio income, Schedule B, right? So you have dividend and interest. Third criteria is when you have rental income, which is Schedule E, and then partnership. Fourth is when you receive something as income from dissident. So this again related to your estate tax. When a person dies, there are typically three returns that gets impacted. One is his or her individual tax return. And we gave a very good example. Let's say there's a lady who died. The date of death till your return filing date, there will be the last return that will be filed for that lady. That is called so we'll have deceased final income tax return, which will be Form 1040 for that person. And till the date of death, whatever money was earned by that person will be booked in her books as a return. But after the date of death, that means after the first return that gets filed, the person who's deceased, that person's property goes and vests with the estate. Why? Because dying is a taxable event in the US, and the estate has to value all of that property. And then there's a gift tax, so unified estate and gift tax that gets applicable. And if there's any tax that the estate has to pay, those taxes will be paid. And if you look at it, there will be two returns that will be filed. One is 706, which is one-time estate tax return, and the other is estate income tax return, which is 1041. So till the time the property does not legally pass on from the decedent to the beneficiary, any income that the person receives with respect to the person who has died, either by the estate or by the beneficiary, is going to be regarded as income with respect to the decedent and will be offered to taxation in any of these forms. Form 1040 of the deceased, the estate's income tax return, and the beneficiary's income tax return. Okay, so this was another area that we drilled down and we did a lot of MCQs in this area, right? So that was the first part. where we had a lot of silos. See, business income is a big area. My suggestion is when you do each of those smaller areas together, you should be able to put it in bigger silos so that you can revise it properly. So, as an employee, portfolio, rental, income with respect to a dissident. That comes the first one. When we come to deductions, so actually, if you look at gross income, guys, it is not just gross income, it is actually implied as income minus deductions. This is the final figure. Also, one of the schedules that we file is Schedule C. That Schedule C gives you the business income. Okay. So if I'm a sole proprietor, then I have to file. So let's say Pixelearn, and I'm running Pixelearn as an institute. If it is organized as a sole proprietorship, then the money that Pixelearn is making is business income. And from here, I'm allowed business deductions. Now, if you look at it, this is the part that will be tested in both part 1 and in part 2. Because in part 2, we say if you're running as a business, what are the deductions that you get? So what we're doing here is one part which is Schedule C. And in Schedule C, there is a form where we have to get business deductions. What are those deductions? Which is going to be exactly similar to what you do later in part 2. So if I'm now a company run as a sole proprietorship, and if I'm paying money as compensation to my employees, that becomes my business deduction. If I'm paying rent, then I get a deduction for rent. If I'm paying for my travel, for my people who are employed with me, then if it's an overnight travel, then I'm going to get a deduction. No deduction for commutation between office and work. If I'm paying for transportation, but that too only if there's an overnight travel, then there's a deduction that I get. If there's a foreign travel for business purposes, then there's a deduction that I get. So all of these now individual ones we would have to dig about and dig deeper for business deduction portion. Then we have the convention travel, transportation, insurance, okay, bigger areas. Qualified bad debts, which are related to business bad debts. Then we have business gifts, till $25 per recipient per year. And again, this you will have to tie up later when you do C corporate taxation. You will see the same thing will be allowed as a deduction there. Startup costs, generally, this is an area which is tested more in part 2. But ideally, if I'm paying a bulk sum amount for starting my business, then I can get that deduction over the next 180 months, starting from the month in which the business is formed. Okay. So all of these, you'll have to do it in much greater details when you're doing business deduction. Okay, a lot of this. Okay. So what we've done gross income, which is the first part, right? So form 1040. So here, if you look at it, if I have to go to form 1040, so see what we did. See, this is form 50 done filing status, we've done dependents. Now, if you look at it, there are certain forms that are very important. One is the gross income. Now, if you look at it, there are certain things which are written on the face of form 1040. So we have W2. This is one form which is very important. All 1099s are important because every time I earn money, the person who is paying me money has to furnish me a form 1099. Okay, so if you look at it, there are certain things which are mentioned on the face, right? W2, tip income, household employee wages, then dependent care benefits, employer provided benefits. All of these will add up, and then I'll get something called gross income. Okay, so if you look at it, there are other schedules. Can you see this? Some of the items are written on the face. Some of them have to move from where? Some of them have to move from from schedule 1. So all the other items of income, which I don't show separately on the face of form 1040, I put it in part 1. Okay, then there are some major areas, like if you look at it, schedule B, which this is your portfolio income. Okay, so all my interest, all my dividends. In the dividends, I need to know how much is the ordinary dividend, how much is qualified. So if you look at form 1040, can you see? You need to give what is your tax exempt interest. This comes from schedule B. And out of dividends, you will have to let the people know how much of it was ordinary dividend on which you will be taxed, how much of it was qualified dividends, because qualified dividends will be taxed at a lower tax rate. Okay, so all the income coming on the face on schedule 1 then on Schedule B and Schedule E will all flow and become a part of gross income. Here we also have Schedule D, but we are going to deal with Schedule D separately. Also, you would have farming income in Schedule F, which will all flow and become a part of gross income. So that is one big area. And I'm pretty sure when you invest some 50, 60 hours doing that area, the revision, if you have some bigger silos in your mind, becomes very simple. Okay, so that was one big part getting. Now you come to the second part, which was adjustments. Again, 9 different items. 2 or 3 of them are really important. The others are really simple. You just need to know the threshold limits and it will be sorted. IRA is a big ticket item. Alimony we've already covered, and self-employed. I think if you do these two, the others are really simple and it will just come to you when you're doing it. IRA, a very basic concept of IRA, was there were 3 kinds of IRA. The one, and again, who chooses this IRA? Your employer. We don't choose the IRA that we want to be in. The person whom we are working with, whoever, whichever model he or she is having, we are going to abide by that model. So we have a traditional deductible IRA, we have a non-traditional deductible IRA, and we have a Roth IRA. The money that you put to all of them as a couple, you can get maximum $13,000 as a deduction, which can be further lowered by the individual's compensation. So it's either the money that you have or the money that you're contributing to the IRA till $13,000, whichever is lower, will be regarded as a deduction. For a traditional deductible contribution, okay, if I'm putting money in the IRA, so typically what happens, I put the money, an equivalent part my employer puts, both of that money goes and rests with the IRA account. That IRA generates interest, and that interest becomes, when the moment that I get the money, there's a big payout from there. So when I put my money, I don't get, so if it's a deductible IRA, when I put the money, I don't pay tax on it. I get a tax deduction. So over, let's say I work for 35 years, 40 years during my working life. The time when I put the money, I don't get a deduction. That means I'm not paying tax on it. The same. So I put the money and that money generates compound interest, and then there is a big payout. The money that I put in, I did not pay tax. Okay, the money that I put in, I did not pay tax provided I put in that money before the due date of filing the return. So I put in the money, did not pay taxes. Now, when I get that return, I have to pay tax on the principal. But even this earnings that was tax free earlier will be taxable as a payout in my hand. So, what is the benefit? I have avoided paying interest, I have avoided paying tax over the next 30, 40 years of my investment in the company, in the IRA. And when then I get the payout, the entire payout becomes taxable in my hand, both the part which reflects the money that I had deferred and not paid tax, but also the accumulated income on it. Okay. And here we had these deductions, and we did a lot of sums on this, where we said that in 2 situations, if uh, if as a couple, if you get, if you hit a AGI threshold where you are rich, and if you, one of you are in the retirement plan, right? So what we say, if you're rich and you're in a retirement plan, you become ineligible. Husband and wife are tested separately unless and until you are super rich, in which case you will be tested together, right? So this is the first kind, is the most important kind of IRA, which is generally tested. Remember, maximum deduction is $13,000, limited to the amount that people are earning as earned income. Provided you pay the installments by the due date of the return, which is 15th of April, you get to save 13,000 worth of deduction, the taxes on account of contribution to IRA, provided you are neither rich nor in the retirement plan. As a couple, you are tested separately unless and until you become super rich, when you have to be tested together. Now, this you would have done in much greater detail with so many examples. If you remember, we did this in the class. Then we have a Roth IRA in which you don't get any deduction. That means when you are paying taxes today. So there's no deduction. That means tax paid on the contributions. Okay. So that is the reason when you get the payout, you've already paid tax on the contributions. Now the payout, the portion of principal becomes tax free, but the interest becomes taxable. Okay. And then we have a Roth IRA where I don't get a deduction, but the money is put in. The earnings, of course, when they accumulate, I don't pay any tax. But here, the only delta is both the earnings as well as the principal can be tax free provided you're using it to meet certain criteria. So there are a lot of criteria where they tell you that you can't withdraw money from the Roth IRA before a particular time limit and before you've invested the money in such a such time span. If all of those criteria are met, then you don't pay tax either on the principal or on the earnings at the time of the payout. Okay. Okay. And then we defined all of this really well, where we had the threshold limits and we spoke about how the phase out works. Now, this is very important because you will get direct questions from here where they give you the AGI of the combined MFJ, and then you're supposed to be figuring out, are you rich? Are you super rich? When you get the deduction, how much deduction you will get. So, this was done in a much, and this is something that I would expect all of you to be having on the tip of your fingers because you will get questions from here and you will have to remember all the threshold limits. Okay, so that was the first thing, which was IRA. Then the next thing that came was the self-employment. And here, if you wait, before we go here, I want to show you this. This, right? This is, no, not this. Where was that? I've not put it here actually. I've put it in other taxes, I think. But yeah, I will show this to you as a part of other taxes, where in FICA you have total 15.3% as your self-employment taxes. And if you're the employer and the employee, you have to pay full 15.3%. But if you're the employee, one half of that will be tax-free, right? So what we say is generally whatever money you're receiving, take 92.35% of that money, and then one half of that will be FICA taxes that you're going to pay as a self-employed person. And this is the amount that gets reported in Form SE, self-employment tax that you have to pay. So as a sole proprietor, you get a deduction for one half FICA for all the money that you pay for health insurance, as well as the money that you pay for retirement. And here for a self-employed, earlier we used to have something called a KO plan. Now we don't use that terminology, but we have something called the Simplified Employee Pension Plan, or you have a simple IRA plan, or you have a 401k. And there are different threshold limits given. So, as an employer, if you're a self employed, you get one half of your social security taxes, full 100% of your health insurance, and the money that you put to retirement, and you're going to get that as a deduction. Okay, so if you wrap up, and then we had all of these educator expenses. So there were 9 areas, if you recall. Out of those 9 areas, two, I would suggest that you do it with much greater details. The others are pretty simple, and you just need to know the threshold limits and the phase outs wherever they're applicable. Okay, so we started with nationality. We've done filing status. We've done the filing requirements. We have done the dependency. That's one part. Then we went to gross income. Big hobby list. We did schedule the master form 1040. We did schedule 1. Now, schedule 1 has two parts. If you look at it here, the first part was your other income, right? The next part is your adjustments. So there are again all of these adjustments, which is wise as him. These are the most important ones. The others are smaller ones. We do all of that, and then the total of adjustments that we have is carried forward in Form 1040, if you remember, right? So we have taken all of this, and from here we're going to get the deductions, which is going to come from Schedule 1, line 26. So this is Schedule 1. From line 26, this money would go in and be a part of your adjustments, right? So what we've done gross income, which will include your deductions for your Schedule C, right? So if you look at it, 1, 2, 3, Schedule A, B. So this was your sole proprietorship income, right? Which is Schedule C. So this is the income that you're going to make. And all of these expenses, this was a business deduction that we were talking about. As a sole proprietor, all of those business deductions would come here. The final money that you will make in Schedule C would flow down in Form 1040 as a part of your sole proprietorship income. Okay, so we have Schedule B, Schedule C, Schedule D, Schedule E. All of that flowing in, and then all of it will come in Schedule 1, which is a part of your other income and adjustments. Okay, so all of this, so we've done Schedule 1, Schedule B, C, D, E, all flowing to Schedule Form 1040. Okay, Theoretically, we've done gross income, we have done adjustments. Now we have something which is AGI. Okay, so that was the first part getting over. Then we move on and then we speak about the standard deduction. Okay, so we did all of this. Now we have either the standard deduction or so we did all of this, right? Then we have standard deduction or itemized deduction, whichever is higher. Now, in the standard deduction, we have different things, but in itemized deduction, we have total actually 3 and 3, 6. We have to put it all in one bundle and then we have to map it against the standard deduction. This one I've given because in many answer choices, they will give you miscellaneous itemized deduction. Understand miscellaneous itemized deduction used to be there earlier before the Tax Cut and Jobs Act. Now it is no longer applicable. So any answer choice that gives you miscellaneous itemized deduction, you will have to scrap it. So you have 6 items, each one of them do it in details, will add up and become a part of itemized deduction. Where do you show it? Schedule A. All your personal expenses goes and gets booked in Schedule A. So starting from charity to your medical expenses, everything. 6 items. Now, this is very, very important, guys. Okay. Starting from medical expenses, whom do you get the expense? Okay. For yourself, your spouse, your dependents. When do you allow, when are you allowed? When you paid it. Doesn't matter whether credit card swipe is done this year and the payment is done next year. Even if the swipe is done this year, you're eligible to get the deduction. How much is the amount that you're allowed? You take all the medical expenses that are qualified, but out of that, you reduce your insurance reimbursement. And then the money that you paid, which exceeds 7.5% of your AGI, is eligible for claiming standard deduction. So when you go to your Schedule A, I'll just show it to you. You will see that there are distinct 6 sections. Each of those sections you will first meet, and whatever is a net figure will get booked in Schedule A. And then you add all of that up and you match it against standard deduction. Whichever is higher, you get that as a deduction. Okay. So this was medical. Then you had taxes. You have it for your state income taxes. You'll have it for property taxes. For sales tax, you can either have the state sales tax or the state income tax. You cannot have both. Okay. When are you going to be allowed the tax deduction? When the taxes are either paid or they are incurred during the year. How much of it is allowed? This is very important. Till a $10,000 on total of all state and local taxes that you have paid. Okay. And here you have a big dhobi list of what is allowed as a deduction and what is not allowed as a deduction. So you need to keep that into picture. Okay. And then we have this so big a list for your interest income. General rule, if it's a personal interest, it is disallowed, like your credit card interest. If it's investment interest, it is allowed only to the extent of your investment income. So if I'm earning money by keeping money passively in my fixed deposits, and if I'm earning some, if I'm paying certain amount as investment expenses, then the expenses will be allowed only to the extent of my investment income. Again, this is something, if you remember, if I'm buying my own house in the US, till a particular amount of home acquisition indebtedness will be allowed as exemption. And so on the loan of $750,000, whatever interest is being paid will be allowed as a deduction. Also, if I'm taking a loan by putting my principal home as a collateral, and the money that I'm using is for the capital improvements of my main home, in that case, even that indebtedness called the home equity indebtedness will be allowed as a deduction. Okay, so general rule 2C M is for ICO. 2C, that means charity, casualty. M, medical expenses. I for interest. D for taxes. O for other itemized deduction. So I take all of that. So we've done medical expenses in excess of 7.5% of AGI. Then we did the taxes, state, local. What kind of taxes? Income taxes. Remember, never federal taxes. Income taxes, property taxes, sales taxes, but provided it's either a state sales tax or a state income tax, cannot be both. Okay. And then we had interest. There was again a big list. So this was a big area. If you did, we did so many MCQs in this area in the class. But general rule, we say if I'm as an individual, if I'm investing in charity, then I need to know what I am giving as a contribution and to whom I'm giving. There are certain organizations where the IRS would want me to give because there's more transparency. We call them 50% limit organizations. And then there are those which are non 50% limit organizations, right? So if I'm giving to very qualified charities, general rule, they become 50% limit organizations. If I'm giving to a private foundation, uh, again, in that case, we'll have to figure out what kind of a foundation is it. In that case, it may have a non 50% limit organization. So, on what criteria you're going to get your charitable contribution deduction? What are you giving? So, are you giving cash? Are you giving something which is not cash, but not an appreciable property, but a depreciable property? So, they are termed as ordinary income gain property. And the third is long term capital gain property, your house, building, and all of that. So, what are you giving and to whom are you giving? If you're giving cash, it's awesome. I can give you a maximum 60% deduction on the AGI. If you're giving an LTCG property, that means, let's say, if I'm giving my entire property to ISKCON or to, let's say, Ramakrishna Mission, in those cases, if it's the only investment that you're giving, if it's the only charitable contribution that you're giving, at the max, you can get a 30% deduction of your AGI. And anything in between. So if you're giving cash and LTCG, okay, maximum that you will get is either 30%. So if it is cash, it is 60%. If it is a depreciable property, it is maximum limit is 50%, or the balance which is left. So we did questions on this. If you remember, we had the graded weighted. First cash, then ordinary gain, then LTCG property, and then for all the two things, whichever is a lower, we want to take it. So there were a lot of questions that we did in different scenarios, scenario 1, scenario 2, scenario 3, and then the mix. All of that you will have to bridge up, keep it on your fingertips, and revise it at the time of itemized deductions. Okay? And then we had casualty, where we said that first important thing was it has to be only in federally declared disaster areas. Whatever number of losses you have, you take a smaller loss, which means either the loss in value, that means before the loss, after the loss, what was the delta, or the adjusted basis of the property, whichever is lower. You take that as a loss, reduced by insurance recovery. Whatever is a loss, you reduce it by $100. Remember, this is a very weird $100. I don't know what is the purpose of this. To take the smaller loss, reduce it by insurance recovery, and then reduce it by $100. And then, so basically, what you're saying is that there's a huge federal disaster, the Katrina storm that came, huge federal disaster. So, only in that case, not in smaller tremors, you only say, let's say, tsunami came. Only, and then tsunami, I lost my house, I lost my car, I lost my office building. So, in that case, I will take each loss, figure out which is lower, the amount of decrease in the fair market value or the property value in my books, whichever is lower, reduce it by insurance recovery and $100, and then you add the eligible losses for all the different properties that you lost, and the sum that exceeds 10% of AGI will be allowed as a loss. So remember, in medical expenses and in charitable contribution deduction, it is not the full amount, but the amount which exceeds 10% or 7.5% of AGI. That means we are assuming that as an individual, you should absorb a part of the loss. Only if it is beyond a particular limit, I will give you that as a deduction. So don't forget these. Don't forget this and don't forget this when it comes to individual losses. Okay? And then we had a lot of other itemized deduction. The most commonly tested of them is gambling losses. You include the gambling winnings in your gross income. Only if you take itemized deduction, you will be allowed gambling losses, but only to the extent of your gambling winnings, not more than that. Okay, so when you have gambling winnings, you take the entire amount as gross income, but the losses you will be allowed only to the extent of gambling winnings and only if you're itemized, not otherwise. Okay. So there are a whole Dhobi list. The most important one, which is texted, is gambling losses. Okay. So if you look at it, see, this was my standard deduction, which is Schedule A. Okay. So I did Form 1040, Schedule 1, 2, 3, and then we have Schedule A. So if you look at it, this was Schedule A, which we have sorry. Yeah. Yeah. So this was Schedule A that we've just done. medical expenses, taxes, interest. Then we have gifts, casualty, other itemized deduction. So total of itemized deduction will now flow through your form 1040. So can you see this? It's standard deduction or itemized deduction. You have to take either of the two. So it's either standard deduction or itemized deduction, where you will get itemized deduction from Schedule A. So we have done Form 1040, we have done Schedule 1, which is other income and adjustments. Schedule 2 is left, Schedule 3 is left. Then we've done Schedule A, which is itemized deduction. We have done Schedule B, which is portfolio income. We have done Schedule C, which is business income. Schedule D is left because we'll do it separately as a part of capital gains. Schedule E is rental income. Schedule F is farming income. And we have done Form W2, which is a part of wages. All the 1099s, which is the income that I'm receiving from people when I'm not working under them as employees. All of that has come up to Form 1040. Where are we? We have taken our itemized deduction. Now we just need to know standard deduction. Whichever is higher, you're going to take it as a deduction. Okay. So again, what was the rule for standard deduction? Generally, we say that we are going to put them as two categories. One is the basic and the other is the add-on. Add-on is generally given only to those people who are really old. What is the old criteria? More than 65 years or equal to 65 years during the taxable year. Or if you're blind. And we said that the standard deduction depends on what is your filing status. And it's a figure that changes every year. So what we say is this. Can you see it's a big amount, guys, right? So when the dependency exemption was rolled out, we increased the standard deduction phenomenally, right? So for married filing jointly couple, till 27,700, you can claim it as a standard deduction. And even this figure can be increased if either you're blind or you are old or you're both. Okay? So what happens? You get a, so first thing what you need to do is you need to figure out either if you're a married filing jointly or you're an HOH or you're a single. So the first thing is pick up the rate from the basic ones. This is step one, depending on either of these three. Then the next step is to figure out any of the additional standard deductions. So any of the additional cards are you going to get? So I generally use the word top up. Can you top it up? The answer is yes. Every top up has it. So there are 4 top ups possible in case of a married filing jointly. Okay, so it is, let's say, spouse 1, spouse 2, this is blindness, and this is age. So if spouse 1 is blind but not aged, and spouse 2 is not blind but is aged, how many top-ups you get? You get plus 2 top-ups. How do you determine the value of the top-up? So let's say if you're married filing jointly and both the people are blind and old. So you will have 4 top-ups. So married filing jointly, you'll start with 27,700. How many top-ups do you have? You have 4 top-ups. Why? Both of them are old. So both of them are old and both of them are blind. 4 top-ups. How? What is the value of the top-up? That value will depend on what figure you've picked up here. So if it is MFJ, you will pick up 1500. So 4 into 1500. If it is HOH, you will pick up the rate for HOH. And then depending on whether you're blind or you're old or you're both, you will pick up 1850 once, twice, on month. Okay. So depending on the top-up, so you can either have blindness or age top-up for each individual one, for each individual person, you have a top. So as a couple, the first thing is to pick up the rates for basic ones, which differs if you're single or HOH or MFJ. Once you pick up those rates, figure out what is the additional reasons for top up. If one person is blind, nothing else is there. Both of them are below age 65, one person is blind. So what you will take? MFJ 27,700, only one top up 1,500. That's the answer, right? So you take standard deduction, then you take Schedule A, all add them up. Whichever is higher, you take it in your Form 10 form. Okay? And you have a QBI deduction, which generally flows in from a form which is Form 8995. The rationale was that we reduced our corporate tax rate. For C Corps, the rate went down from 37 to 21%. And we wanted to give a similar benefit to the flow through business entities, which is sole proprietorship, partnership, and S corps. So what is a deduction? Maximum deduction is 20% of the business income that you're getting. Remember, only the business income. So if I'm running Pixel Learn, and if I'm getting money from there, then only the business net income that I'm earning till 20% I can get as a deduction. Now, on what criteria does this deduction depend? It depends on what is the kind of business that you're running. So two criteria on which the QBI deduction depends. What kind of business are you running? Okay, so this is the first kind. And we say that if it is a business where your name can attract business. So if you're a football player, if you're a doctor, lawyer, CPA, if you're a celebrity, sports, all of them are SSTB. But if you are a person whose product is one like any other product, you're into a homogeneous market where your presence cannot earn you a differential, then you are treated as a QTB. There were two services. One was architectural services that are clearly meant to be QTB and not SSTB. Why? Because it is linked to your stages of construction, right? So one kind of question that are asked in this area is how do you classify a business as QTB or SSTB? And the second criteria on which QTB business descends is how much AGI not AGI actually. Here you have taxable income. Do you have? So how much is your taxable income? What kind of a business are you running? So what is the definition of taxable income here? You've taken gross income, reduced it by above the line deductions or adjustments, arrived at AGI, reduced it by standard or itemized reduction, whichever is higher. That figure is your taxable income. That means a figure just before the QBI. In that, you're going to put it under three different thresholds: below the threshold, above a particular threshold, and in between. Do you need to memorize these? I'm afraid yes. I would want you to memorize, even though I'm assuming that they're going to give you these figures, but it really doesn't hurt if you can memorize these basic figures. So below the threshold, it's very easy. If you're not earning a lot of money, I really don't care whether you're a QTB or an SSTB. You get a full 20% qualified business income deduction. So general rule, they don't ask you here. QBI is an area which is dealt with really superficially in EA. We are not digging that deep. First, they will question you on what kind of a business are you running and can you classify it under QTB or SSTB. And then it's only the first and the last provisions that are tested. Remember, below a particular threshold limit of taxable income, if you're making, I really don't care what business you're in, you get full 20% of the business income as a deduction. Beyond a particular threshold, if you're earning a lot of money by running your business, for an SSTB, for a person who's a Shah Rukh Khan or an Amitabh Bachchan or a Virat Kohli, I really don't mind. You will not get any QBR. We feel you're earning a lot of money and you don't need this QBI deduction. So IRS deserves money from you. So we are not going to give you any deduction if you are an SSTB in the above zone. And if you're a QTB, just remember this, there's something called W2 wages. So depending on how much property you have and how much people you employ and how much wage do you give, there's a kind of deduction that I give you by which you can reduce the 20% qualified business income deduction that you get. That's it. I don't want you to go any deeper than this. Okay, remember what kind of business? In between, below, and above. Below, everybody gets 20%. Above, SSTB don't get any deduction, and QTB reduces their deduction account of W2. And in between, there is a phase out. I don't want you to remember the provisions. Okay? So there is a separate form for this. You fill up that form and you can take a 20% QBI deduction. Okay? So what we are, if you look at this, guys, if you look at the if you look at this, now see, this makes so much of sense. So assuming that you guys are doing your individual portions really well, we have done the gross income, we have done the adjustments, we arrived at AGI, we have taken the higher of standard deduction or itemized deduction, and we've taken QBI. Now what we are left with is the taxable income. So if you look at it, so in my mind, I'll remember adjustments, Y is as him, Standard deduction, I know there's basic, there's additional for blind, age, basic, there are three, and then I add the top. Itemized deduction, 2 CMs for ITU. QBI deduction, QTB, SSTB, taxable income, in between, beyond, in. That's it. Now I will apply the tax slab, get the regular income taxes, add the other taxes, reduce the credits, reduce the payments, and then arrive at my taxable income. Taxes is easy. You'll just apply the tax slab depending on your filing status, and you will arrive at your federal income tax. AMT is again dealt with in a very sloppy way in the EA. I don't assume that they want you to remember anything about the AMT. So wait one second. I'll just go to those corresponding slides. So AMT and QBI are two areas that are not dealt with really greatly in the US EA business. Okay. So this, if you remember, we have arrived at the taxable income. Then depending on your filing status, you will apply the slab rates, arrive at your income taxes. And now you also know that your capital gains, which is Schedule D, has to be dealt with separately. Okay. Then we have the regular tax that you're going to compare with AMT. And in AMT, what do? You kind of roll back certain provisions and you arrive at the alternate minimum tax that you have to pay. What are those rollback that you have to do? Typically, the standard deductions have to be added back. The preferences have to be added back. The adjustments could either be a plus or a minus. And remember, there's only one credit that you get here, AMT credit, and then you arrive at the alternate minimum tax. Okay, I don't see them asking you all of this in AMT. In AMT, general rule, they test only two things. First is how do you adjust the AMT credit? Okay, which is that the AMT can be adjusted only against regular taxes in future. You can't adjust AMT against AMT taxes. And second, remember preference items are always an add and adjustments can be either an add or a minus. That's it. Okay, and after that you add other taxes. One is the FICA taxes and the other is the net investment income tax, the future taxes, and the household employee taxes. This is an important area, guys. Okay, this is an area which is not very good. People get very inhibited when you get these questions, but I would want you to do this properly because these are questions that can come for each individual area. 4 different areas you can get the questions. Okay, and see, this is what I was referring to earlier. This is applicable even when you're doing self-employment taxes, right? So if you look at this 15.3% that I spoke about, this is generally broken into your share, and so employees share and the employer's share. There are two parts. One is the social security tax, which is generally old age, survivors, and disability insurance. You get 6.2%, and the employee also puts in 6.2%. But here you need to remember that there is a cap. For the year 2023, there's a cap till 1,60,200 of the wages. And then we have a Medicare tax that is paid for old age hospital insurance, which has no limit, but which is 1.45%, both for the employee and the employer, adding up to 7.65% for the employer and 7.65% for the employee, and making it up to 15.3%. There's something called additional Medicare tax, which is only to be given by the employee and not by the employer. And it is only applicable in case if there's a wage in excess of $200,000 or 250, right? So this is an important part and you need to know this here as well as in the self-employment taxes that you paid earlier. Okay. And there are others like net investment income tax, household. For those three, just remember, it's very simple, straight provisions you need to keep in mind. And then we had this whole big list of the tax credits. Okay. There are some big ticket items. Now, earned income credit, probably the only thing that they ask you is it's a refundable credit. Okay. Then there are others like education credit. So here, if you look at it, this is an area that needs a little bit more detailed study individually. If I have to sum up, income, gross income, and tax credits are the only two big areas that is going to take you some time. Okay. So all the credits, which includes your, so again, I have an acronym here that I gave you, which is deal with Mr. Deal with Mr. FR2. So I don't know how you're going to use it. So it's DEALMRFFRR, right? So my suggestion is do it once nicely and then all sum it up and remember it like the top ideas. So deal with FFR. Okay, we deal with two foreign returns. I mean, I don't know how you want to remember this, but it helps if you have an acronym, because then in your mind it's so much easier to run through the entire thing. Okay. Then there's another part called the payment section in Form 1040. Again, here, this is a big ticket item, and the I think this is the only one that are generally asked, and the others are all related to your refundable credits. Okay, so do each one of them properly. And if you look at your schedules, okay, if you look at your schedules, you will now see that we have, so we've done schedule 1, which was other income and adjustments. This is your other taxes. You remember those 4 taxes: net investment income tax, FICA taxes, FUTA taxes, and household employee taxes. All of them come up here in schedule 2. Okay, all the other taxes come here. And then we have schedule 3, where you have all the credits coming in and the payment section coming in. Okay, so if you look at it in Form 1040, now you have all the credits coming in. The first part, which is termed as credits, coming in from schedule 3, and the second part, which is termed as a payment section, which will again come from schedule 3. Okay, so we have Form 1040, gross income and adjustments. Other parts of gross income and adjustments coming from schedule 1. Schedule 2 would have your other taxes. Schedule 3 would have your credits and payments, all moving up to Form 1040. Then you had Schedule A, which was itemized deduction. B, portfolio income. C, business income. D, that's portion we have left here, that's capital gains. E is rental income. F is farming income. And then we had Form W2, and then all the 1099s and the self-employment, which was Form SC. These are the big forms that I want you to keep in mind. Okay. Once all of this is done, then we complete a big area uh, for your Form 1040. After that, all that you need to remember is your statute of limitations. Okay. So when can you file your claim? This is important. I'm definite that you're going to get a question from this in your exam, which is 3 years from the date the return is filed, or 2 years from the date the taxes were paid, whichever is later. Okay. So with this, we finish the first full part, which is Form 1040. Now only Form D is left, which is property taxation. And this, I'm supposing, at least for the people who did it with me, this was a very recent thing that we've done, and I'm pretty sure all of it, this is very live in front of you, right? So the first question is it a property? Yes, it may be something which is fixed, or it may be something which is movable. Irrespective of whether a property is fixed or movable, we're going to call it as a real or personal property, but that is not how we define whether what I'm selling is a capital asset or not. We define it on the basis of whether I've used it for business or whether I haven't used it for business. Only personal or real property not used in trade or business is classified as a capital asset. And if I'm holding it for more than a year, it would result in LTCG. If I'm holding it for less than a year, it will result in STCG. For property which is held for business, technically, I'm not going to call them capital assets. I'm going to call them Section 1231 assets, Section 1245 assets, and Section 1250 assets. Now, this is an area which becomes very important when you're going to do Part 2. I don't see them asking a lot of questions, at least in this category in Part 1, because this is more related to the business use of assets. Very nice. Yeah. So the first question that you need to ask yourself is, am I talking about a capital asset? If yes, now we need to go to certain provisions. Like, so everything in capital asset is only depending on certain criteria. The first thing is, what is amount realized? So what we're talking about in capital gains, if I am selling a capital asset, then the money that I'm making as a gain, general rule, I have to pay tax on it. And the money that I'm incurring as a loss, general rule, I do not have to pay tax on it. That's a tax deductible item. So what we do, we need to first understand how much money I'm realizing, which is a sum total of the money that you receive, your obligations that the other party takes over, anything that you receive apart from cash, net of all the selling expenses, will give you the amount that you realize. And then you need to figure out what is the value of that asset in your books. So if I'm having a car, and if I'm now using the car for personal purposes, and if I'm now selling the car, assuming that I held the car for more than a year, I will have a capital gain. I need to figure out what is the adjusted, what is the value in my books, and how much is the money that I get when I sold the car. The money that I get is amount realized. The money in my books is called the adjusted basis of the property, which could be different if I'm buying the car, because in that case, all the money that I paid for buying the car, all the depreciation that I have taken till date, all the capital improvements and everything I'll net off. And this is very similar to gap rules, guys. Okay, so this is very easy. For a gifted property here, again, we have the emphasis of gift tax, right? And we say that if it's a gifted property, you have to think about uh, the gains and the losses are generally not considered. The giver can have the gift tax, but only on the appreciated value of the property. The receiver will always take the property as it is. They will not pay any tax on the gift that is being received. The problem happens if the gifted property value comes down at the time when the gift was made. So, general rule, gift is a non-taxable event. The value in the hands of the recipient will just be the rollover value that was there in the hands of the person who gifts, that's a donor. But in case if there's a lost property, then we will have to think about the future selling price of that property. If it is being sold at a gain, then it's called a gain zone, and we're going to take a lower value and book a lower gain. If it's in the loss zone, then you book a lower loss, and if it is somewhere in between, you don't have any gain, no losses, zero, right? So that is something that we did for gifted property, which will again be relevant when you're going to take related party losses. Okay. And then we had inherited property. And this is the concept where you're going to tie up again when there is an estate taxation. So we will have an estate taxation where we will say that the date of death, whatever is the fair market value of the property, that value, which may be a step up or a step down, becomes the value of the property in the hands of the recipient. Also, if the executor decides and if the overall valuation of the estate becomes lower and the overall estate tax becomes lower, I can have the fair market value 6 months from the date of death. Okay, so this is the concept that is going to be applicable in estate taxation. So we first big portion is amount realized. Next fixed portion is what is the adjusted basis of the property. And then general rule, if it's again it is taxable, but there are 6 instances where I can avoid paying tax because these are the gains that will not be taxable. Okay, first time home owner, involuntary conversion, treasure. So hit or die. Divorce property settlement. So these were the two big ticket items here. Exchange of like kind business transaction. So these were the three actually. One, two, and three. These were the three big ticket items in the gains which are going to be excluded from the tax net. General rule, all losses are allowed as deduction, except if you can rip them and throw them out. So the wash sale losses and the related party losses, all personal losses are disallowed. So entire capital gains has only these 4 topics, guys. How do you calculate amount realized? Actually, 5. First is it a capital asset? Define. Second, what is amount realized? Third, what is the adjusted basis of the property? Purchased, gifted, inherited. Fourth, what are the gains that are not taxable? Fifth, what are the losses which are not allowed as a deduction? So the entire capital gains, after you've done each individual area in details, you will all wrap it up and put it as one in these 5. And you should be able to revise it when you're sitting down with all the provisions and all the. So every time when you revise it in your mind, you should know, okay, this was a thing, this was a thing, this was a thing. So in one slide, everything that you've learned should be wrapped up. Okay, so we've done Form 1040. And now you will see that this would come as a part of your Schedule D, right? You remember? 1040, 1, 2, 3, A, B, C, D. So this is Schedule D. See, if it's a short-term gain property, if it's a long-term gain property, then what is the amount you've realized? What is the adjusted basis of the property? So this is the amount realized, adjusted basis of the property, gains, losses. Okay? And then there's a summary, and this figure in Schedule D will go and hit your Form 1040. Okay? And then once you do this, then we have further 2 topics. One is the gift tax and one is the estate tax, right? So if you have the gift tax, it's easy. We have a unified system of taxation in the US. Why? Because dying is regarded as a final gift to the progeny. So the tax that you have is called the Unified Estate and Gift Tax. Okay. In gift tax, the biggest area that will be tested is who needs to file the Form 709. When does the Form 709 needs to be filed? And then uh, how much is the gift tax at all that will be calculated, right? So filing of Form 709 is a big area. General rule, the inclusions and the exclusions. So who is supposed to file and who is not supposed to file, both becomes very important. Okay, so gift tax is 709. If you're gifting anybody anything which is more than $17,000 per person per year, then you have to file the gift tax return. We did gift splitting. So as a spouse, if you're splitting the gifts so that individually, so let's say I'm giving you a gift of 24,000 as a married couple. Since 24 exceeds 17, you have to file the gift tax return. So in this area, there's one thing that I want you to understand. Filing a Form 709 versus paying taxes, right? So in my example, if there's a 24,000 gift that I've given as a couple, since the figure is more than 17K, we will have to file the gift tax return. But there we can file another form and say that we have split the gifts between a couple, between two spouses. And since each of them is now 12, and that is below the 7,000 threshold, there will be no gift tax paid. So when do I file? When the gift is more than $17,000 per person per year. When do I pay taxes? Only if it exceeds 17,000 worth of gifts. So if I'm splitting, I will file the return, but I will not pay taxes. Okay. The gift that has to be made has to be a complete gift if the present interest and irrevocable. So if I'm gifting something which is a future interest, after I die, my son is going to get this as a gift. This is a future interest gift. That is not a complete gift. And also, it is not a present gift, it's a future gift. Okay. So remember, in this, the bigger part is who needs to file the return and who needs to pay taxes. Remember, if I'm gifting somebody less than $17,000 per person per year, no reason to file the gift tax return. Also, if I'm giving some gift directly to a medical institute or the educational institute, remember, not to the person, but to the institute directly, irrespective of the amount, I don't have to file the gift tax return. Any gift to the spouse is outside the gift tax return. Any gift to political organizations is not regarded as a gift, so you will not report it in Form 709. And if you're making gift to charities during the year, then if it's an irrevocable charitable gift, you don't have to file the Form 709. Okay, so two things very important. What is Form 709? Who's supposed to be filing it? What amount of gift tax are you supposed to be paying? And then a small part of it is actually the amount of gift tax, right? So if you remember, there's a big amount, some $13 million that are allowed as a lifetime gift. And on that, if you recall, some $5 million is allowed as a gift tax credit. Only if you exceed 5 million worth of gift tax, you need to pay for the tax. And your final estate, whatever is left out of that 5 million credit, can be allowed as a deduction, and only the excess will be taxable. Also, if the husband and wife each have 5 million worth of gift tax credit, if one dies and there's some balance credit, you can add it on to the other spouse and then the final amount will be paid. Right? So all of this relate gift tax, relate estate tax together. Okay, so gift tax very easy. Return, who needs to file, who doesn't need to file, what amount of gift tax has to be paid. That's it. And the third part is gift tax splitting, which anyways you're doing. Okay. What is the due date? Due date is 15th April or 15th of October, right? And yeah, then we have estate. In estate, there are only two topics you have to do. One is what gets included in estate, gross estate. So we say that everything gets included in your gross estate. Uh, Everything gets included in your gross estate. Whatever value of goods that you have, everything gets included in your gross estate. Remember two things, all the expenses of the estate and all the mortgages are initially not excluded. So you put everything in gross estate, then I'll give you deductions, right? What are these deductions? Funeral expenses, administration, all the mortgages, marital deduction. Okay, all of this will be allowed as a deduction, and then you get the gross value, and then you pay the estate tax return of 706. Okay, so that's it. In part 1, you have very small parts for gift tax and estate tax. You just need to remember Form 709, 706. In gift tax, who needs to file the return, who needs to pay the taxes, and when and what amount of taxes. In estate tax, all that you need to know is what gets included in gross estate, what are the deductions that are allowable, and when do you need to file the estate tax return, which is 706, which is 9 months from the date of death. That's it. So if I sum up the entire part 1, only 3 areas: Form 1040, capital gains, gift tax, and estate tax. Form 1040 again. Now see, the if you look at it, we took 2 hours to sum up everything. So if you would have done this individually, all that you have to do is pack them up. When I revise, I should be able to close my book and revise everything. And revise it as acronyms, right? So national, nationality, taxability. And the moment I do this, I know three: US citizen, resident alien, non-resident alien, green card tax, substantial presence test. Done. Then I go to the requirements to file return. Three requirements, you remember? Done. Then I go to filing status. Five status, three rates. Each one of them done. Dependents, two: qualifying child, qualifying relative. The races, port us, done. Then I go to gross income. A lot of Dhobi list, but in my mind I will segregate Schedule A. Now from gross income, I want you to remember Schedule A, Schedule B, Schedule C, Schedule D, Schedule E, Schedule F. All coming up to Schedule 1 and then going up to Form 1040. So when you revise that, I want you to visualize the forms. Then I go to adjustments, where Schedule 1, what, wise as him, done. Then I get a gross, the AGI. From the AGI, I get what? Standard deduction. How much is it? Basic, I have three different rates: add, top ups, additional standard deduction, blind, and old, 65 years. Then I know the top up, done. Itemized deduction, 2 CMs for ITO, where Schedule A, match it up with standard deduction, whichever is higher, take it, done. Qualified business deduction, what is my taxable income? What kind of business do I run? Below, above, in between. Below, both same, 20%. Above, SSTP will not get anything. Here there's some deduction. In between, there's some deduction. Done. Now I arrive at taxable income. Then I apply the slab rates, any three. I know the qualified dividends and LTCG will have lower rates. Then I have other taxes. Four taxes: NIIT, which is net investment income tax, the FICA taxes, self-employment taxes, FUTA taxes, and household employee tax. Done. Then I go to credits. Big Dhobi list. I know Schedule 3 I will go. I will take all that deal with foreign return, right? Deal with Mr. Foreign Return. Okay, so deal with two Mr. Foreign Return, something like that. Then I go to payment section, which was another acronym. I add that up, I get in the taxes. Finish. Then I go to Schedule D, amount realized, adjusted basis, three times, purchased, gifted, inherited, get a tax, hide, or hit or die, gone. Then I go to loss, rip them off, WRP, gone. Then I go to gift tax return from 709. Who needs to file, who needn't? Gift tax. The thresholds for the gift tax done. Estate 706. Estate tax return, due date 9 months. Okay. Gross estate, I just remember mortgages and all the funeral expenses, all the expenses not to be included in gross estate. The gross value I will take, less the deductions. What are the deductions? Done. That's it. Entire part 1 done.